Hi everyone. Thank you for joining today's on-demand webinar brought to you by ELMO Software. My name is Rachael Smith and I am the Payroll Support and Compliance Lead for ELMO. I'm thrilled to be here with you in one of the busiest times that we have throughout the year in terms of payroll, but also one of the most important times. Whether you're a HR professional, a payroll officer, or business leader, we know end of financial year compliance can be overwhelming. And that's why we've brought in some experts to walk you through the key changes, reporting obligations, and what you need to know about Payday Super, both now and into the future. So joining us today are two industry experts from A&M. So we've got Nathan Hamilton and Alston Camp. Nathan and Alston work closely with businesses across Australia in respect to their tax and payroll compliance and lots of different things that I'm sure they will share with you. This session's been designed specifically for our ELMO clients. Our goal is to help you navigate the period with clarity and confidence. So sit back, take some notes, and reach out to your ELMO account manager if you have any questions, or to A&M as well. So without further ado, I will hand it over to Nathan and Alston. Thanks, guys.
Thanks, Rachel, and thanks everybody for dialing in or downloading the session. Might just pop to the next slide if that's okay, Rachel. And I might just start by just expanding a little bit. A lot of you probably don't know much about A&M because we are a very new firm in the Australian market. Commenced in Australia about 12 months ago, but have a long history back to the 80s in the US and globally. So most known in the US for being appointed to the administration of the Lehman Brothers, still to this day the US's largest bankruptcy, and a number of other notable appointments. But the Australian story is much newer, with a significant investment into Australia at the start of last year, and we've gone ahead at a rate of knots. Now got 50 partners and about 200 staff. And in Alston and my part of the business, we're the employment advisory team. So both have Big Four backgrounds. I'm very fortunate that Alston has joined me at A&M from our former firm, KPMG, and have both been advising clients of all sizes in relation to all things employment. And so we're delighted to have the opportunity to talk to you all. The topic today is focused on payroll and year-end reporting issues. There's potentially a lot to that topic. So we've zeroed in on a few parts of that, looking at STP2 reporting and specifically some of the observations and quirks that we often talk to clients about in relation to the disaggregation of gross and all of the different ways in which that we report employee pays. But broader than that, I want to also look to the future and talk a little bit about Payday Super, which, assuming everything goes according to schedule and we don't have any deferrals, is well and truly on track to come into force from 1 July next year. And so as we look at STP2 and some of the nuances about system configuration and reporting, it's even more important as we look ahead to a regime like Payday Super. And we'll talk a little bit about what that is and some of the things that you can do to prepare. We'll also talk a little bit about payroll tax. So that other annoying payroll year-end obligation that I'm sure you all love. Some of you in payroll might be fortunate enough to have payroll tax dealt with in a tax team, but we find that more often than not, payroll tax sits squarely with payroll. So we'll talk quite briefly about some of the risks and focus areas that we tend to talk to clients about in that space. So without further ado, we might flick ahead. Couldn't go to the next slide, please, Rachel. That's just Alston and I. You've met us, so we might get to the next one. But it's worth noting that Alston and my details are in the slide deck. So obviously, anything that we talk to today, we're more than happy for you to reach out and we can support with more detailed or more specific sort of questions and answers outside of the session. I believe, Rachel, there is an opportunity potentially to submit questions via
Yeah,
ELMO
that
as
will
well.
be.
So anything that goes through that channel will obviously work with the ELMO team and respond as well.
Excellent.
I think that's enough about our firm. There's a lot of boxes on that page showing all the different things that we do, but I think everyone gets it. So we might keep going. So why is it important? So starting with STP reporting. So, why is this important to get right? And I mean, these things might seem pretty obvious, but I think it's a helpful context setting. First of all, the reporting that we put through the payroll and submit directly to the ATO ultimately is what goes to the employees in their income statement. So it's their source of truth. And connected to that is their income tax reporting. So all of that information goes directly to the ATO and is pre-filled into their income tax returns, such that any errors that we make in STP has the potential to impact the tax obligations of our employees. Other government agencies outside the ATO are also very heavily focused on STP reporting. And the STP regime was heavily sort of geared towards ensuring that Services Australia gets the information that it needs to assess eligibility for various payments. So there's all sorts of income tests. Services Australia needs to understand how people are being paid and what components should be included and excluded so that they can appropriately determine important things like benefits and entitlements. And finally, with the extent of data sharing and data matching that now exists across the various regulators, accurate STP reporting is critical to minimise risk and just reduce the likelihood of queries or compliance actions arising from one of the regulators. Plenty of examples I can talk to there. Lots of our clients do get questions from the ATO in relation to things like superannuation compliance. The ATO has been very public, actually, in the fact that they've been investing heavily in their data analytics and data matching capabilities to use STP2 data more effectively to identify potential issues in closer to real time. So they're very, very focused on ensuring that the data that they have is being used to identify when things might be going wrong. We have started to see an increase in those sorts of questions coming from the ATO, as well as some general employer obligations review activity as well. But it's not just the ATO. Certainly, other regulators like the state revenue officers have access to this data. And we do see audits and questions coming from state tax authorities that are interested in understanding why there might be certain information being reported to the ATO that looks different to what's being fed through to them in the payroll tax returns. Probably another one's, even simple, reconciling questions. A lot of clients get correspondence when the ATO recognises that the amount of PAYG income tax that's been withheld that's been received into the ATO's accounts doesn't match the amount of PAYG income tax withholding that's reported through STP. Now, that seems like a pretty obvious one-to-one, but it's quite surprising how often those mismatches happen. And in many cases, how much our clients can struggle to actually reverse engineer that and work out what might have gone wrong. So this stuff is really important. We absolutely encourage everyone to have adequate focus on it to ensure everything's correct. Might just flick forward, Rachel, if that's okay. Now, I'll hand over to Alston to pick up the STP2 detail. I'll interject a little bit with some questions and comments potentially where relevant. STP2 is obviously broader than just the various elements to be reported under disaggregation of gross, but this tends to be where we find the most questions and errors arising. So it's a certain area of focus for our clients. It's also worth recognizing that STP2 is not new. All of you now will be reporting through STP2. So we're not talking about a migration to STP2 like the discussions we were having over the last number of years. This should very much be a refresher of how your systems should already be configured to be correctly reporting for STP2. But errors do happen, and so hopefully you take something out of the discussion today, and to the extent that there's anything you need to look a little bit closer at, do so or reach out with questions. So without further ado, I'll pass over to Alston. Thank you, Alston.
Thanks, Nathan. So before we kind of get into the detail of the disaggregation of gross, thought it'd be a good starting point just to talk through what are some of those mandatory items that are required to be reported through STP. And so we've listed a number of them there, and they do fall into the category of gross or elements of growth that do need to be disaggregated. So we've got salary wages to the employee, payments of remuneration to a company director, return to work payments, so lump sum W, ETP payments, which is almost a standalone session if you want to get into the detail on those particular type of payments. And we've got unused leave and parental leave. As you may be aware and familiar with the year-end process, there are other payments that can be reported through STP2, and I'd say the vast majority of people are reporting these in any case just because of ease of administration rather than doing it under different regimes. But we've got child support payments and garnishes, REST, so reportable employer superannuation contributions, which we'll cover off in a bit of detail shortly, and of course reportable fringe benefit amounts. So some of you might feed into the annual FBT process, which is going on with a lot of businesses currently. And through that, employees might have a reportable fringe benefit amount where they receive taxable benefits or reportable benefits that are greater than $2,000. And so that reportable fringe benefit amount needs to be included as part of that year-end reporting obligation for employers. We might just move to the next slide. So disaggregation of gross, so like Nathan mentioned, this isn't something that's new. It's been around for a number of years, and you may have been quite familiar with the process of going through and identifying how your code should be configured from a reporting perspective. But if we take a step back in time and reflect on what's changed, so STP1 was really quite simple, just reporting one gross number. STP2 came along and you've been asked to report on a more granular detail. And so there's a range of payments there, gross overtime, paid leave, allowances, etc., which are now required to be reported as part of your STP filing. And with each comes complexity. There are nuances across each of the pay categories and differences in way things are treated depending on whether they're taxable or non-taxable, for example. I think the main kind of call out in relation to that shift and how you set out your reporting is, one, making sure that your payroll system's configured correctly, and you're informed about the nature of the actual payments and the types of codes that you're using, because this could impact not just STP2 reporting, but it could impact things like superannuation. If you've got things you configured to be superable but might not otherwise be superable, then you have a potential super overpayment if you're using that code incorrectly. And other things like payroll tax payments and things like that. So brief history lesson before we jump into some of the kind of key categories. Next slide, please, Rachel. So gross. So even though it's a broad category, there is some complexity in the types of payments that are reported within gross. It's essentially acts as a catch-all category. So as we step through and as we showed on the previous slide, there are distinct categories of payments that are required to be reported now under STP2. And any payment that falls outside of those distinct categories, you effectively report into gross. But there are some nuances and things to be wary of. So just rolling down the list, the types of payments that we typically see included in gross would be your ordinary hours, casual loading, shift penalties, travel or training allowances, piece rates or daily rates for work during ordinary hours, flex time, payments of workers' compensation where the employees return to work, so maybe on light duties, and any breach of rest break payments. But in that, there are some things that you need to consider. So if we take the shift penalties, for example, a common misconception is because a shift penalty is paid at a higher rate, sometimes the overtime rate, that it should be categorized as overtime. And that may not be the case in all instances. And so being aware of what the shift penalty relates to, the circumstances it's being paid, and the nature of the work being provided during that time will then generate the correct outcome for whether it's included as gross or separate overtime category.
And Alston, that's probably a good segue to sort of call out superannuation again, right? So an obvious example of where a correct characterization for STP purposes might also have a very clear superannuation implication as well. Getting confused between shift penalties or penalty rates and overtime rates is a really common one that leads to super non-compliance. Sometimes it's just simply not understanding what's in and out for super, but often it's actually pay elements being used for multiple purposes. And actually the same element in different circumstances means different things. And so really clear understanding of your relevant instruments, how your payroll is configured, and that you've got appropriate elements configured for each of the circumstances that you need to use them is fundamental.
Yeah, agree. And the second example there around the breach of rest break, that's another one where it is a requirement to report under gross. And so even though they might be paid at an overtime rate where you've not provided that rest break, that doesn't mean it's in the nature of overtime. And so again, that distinction between what the payment's in relation to and the kind of parameters in which the code's been used. The last two are other ones that a lot of clients may get tripped up on. So public holidays not worked is reported under gross. It's not leave. And for travel time during ordinary hours, again, that's reported under gross. The other allowance code, which we'll get into, is typically used where you've got overnight travel. And so that's the distinction there. So if you move on to overtime. So this is quite a broad category. Essentially, you're capturing payments that are provided in the nature of overtime. So you've got your normal overtime payments, overtime components of salary, leave loading that relates to overtime. Now, if leave loading is not in relation to overtime, then it's paid under leave code 0 or O, which we'll be covering a bit later. On-call standby or availability allowances. Again, if these are paid during ordinary hours, then it will go through as an allowance code rather than overtime. Callback payments, overtime bonuses, part-time additional hours, excess travel or training outside of ordinary hours, and bonus for working overtime. And so with that bonus code, if it's not OT, then it goes into the bonus category. Again, we've got some examples there of where kind of confusion can arise. We've got codes used for different types of payments. I think kind of the key call out is to really understand for that particular code, what is it being used for? Is it being used to pay the employee for work performed during ordinary hours? Or is it really used for when employees are outside of those ordinary hours? So, for example, your on-call and standby, or even the bonuses there.
And what does ordinary hours mean in the context of your workforce? You've got to go back to your instruments, your relevant awards, and ensure that for the people doing the work for you, what is ordinary hours in their context and what hours would be in the nature of overtime? This is hard stuff, and that's before you actually get to setting it up in the system, right? So we're very, very mindful of the challenges that you all in payroll world have to navigate. The on-calls are a good one. I mean, we do so much super work, so superannuation is always front of mind for us, which goes hand in hand with overtime. On-call allowances, the difference there, if we were to sort of illustrate it, if you've got an employee receiving an on-call allowance for being available to return to work outside of hours, that's overtime. Other on-call allowances, for example, it's common in the health sector, say, for a doctor to receive an on-call allowance, which means they're being compensated for being available and not drinking, etc., so that they can be called in for emergency surgeries and the like. Two different allowances, both called on-call allowances. One is ordinary, one is overtime and non-superable.
I love it when things have 6 different meanings in different spaces. Makes it very easy.
Absolutely.
Yeah. So we might move to the next slide. I think it's director fees and lump sum W. So again, these are 2 distinct categories that need to be reported via STP2. I think that the important takeaway for directors' fees is that you are looking at just the fee component. If there are other allowances or bonuses paid to the director for services provided, then they do get included at those particular allowance and bonus categories. One kind of challenge that we see clients face in relation to directors' fees is that not all directors may be paid via payroll. A lot of directors do provide services on an invoice basis, and so the challenge is how you kind of report those payments where they are paid by invoice. And then the second kind of element of that is the superannuation impact or component of that. And so directors' duties are performed by the individual, and under the Corporations Act, they're required to be a individual or a person. And so that gives rise to obligations of superannuation. And so when they're invoicing, it is often tricky for businesses to process that superannuation where you've got situations where you're paying by AP.
It is a bit of a contentious issue, and it's really common for directors to invoice. There's different technical views out there, but I think most would take the view that the services of directors are typically individual services that should be in payroll and reported and subject to super. If this is a relevant circumstance for your business, perhaps have a discussion internally and get some advice if needed. If directors are invoicing, sometimes it's because they operate on multiple boards and potentially don't want to deal with different tax-free thresholds and exceeding superannuation caps and the like. But there's different ways to solve those problems.
And so lump sum W are payments where employees are returning to work. Distinction there between lump sum W and workers' comp is these are generally born out of end of industrial action or things that have required the employee to come back to work, rather than someone who's been injured in a workplace accident and is on workers' compensation. So that's a distinct category, lump sum W, and that feeds into some of that Services Australia reporting as well. Just moving to the next slide. So leave. So under STP2, there's 6 categories of leave, 5 distinct categories, and then almost another catch-all known as other. So I think the key takeaways from a leave perspective are there are 2 elements which make it reportable from an STP perspective. One is there needs to be a payment, so you're reporting any amounts that you pay to the employee. And the second component is that the employee needs to be absent from work. And so, a classic example would be the workers' comp example, where they might be working on light duties. That's not reported as a leave payment because they are actually working. They're not absent from work for that period. So working through the categories, so ancillary and defence leave, this is where your community service, defence or jury duty leave is going to be captured. If an employee is taking an annual leave or an RDO day to undertake some community service work, that is just reported under type O. It's not used under the type A leave category. Cash out of leave. So this is when employees' employment ends and you're paying out some of the accrued leave balances. This is all reported under item C, with 3 distinct carves out. So where it's cashed out for toil, that's recorded as overtime. Cashed out annual leave that relates to overtime is also reported as overtime. And then as we get later on to the unused leave on termination, that's a distinct category on its own. Parental leave. So this is for reporting both government and employer paid parental leave. Important to note is keep in touch days, which a lot of businesses provide. That's actually reported as gross. It doesn't fall into the parental leave bucket. And then similarly, any early return to work bonuses that are paid to employees to kind of compensate them or incentivize them to return back to the workforce sooner are reported as bonuses.
That's back to your point, Alston, about these leave codes being leave, right? Absence from work. So,
Yeah.
keep in touch days or early return bonuses and the like, because there's work being performed.
Yep. Exactly. Unused leave on termination. So this is only used where you've got a normal termination, so your resignation type arrangement. So annual leave, long service leave, and leave loading will be paid under category U. Where you've got a genuine redundancy or invalidity or early retirement payment, this will go under lump sum A. And any long service leave that's pre-78 will be lump sum B. So just watching out for those distinct categories that may fall under the unused leave on termination bucket. And then lastly, workers' compensation. So you only report the payments that you make to the employee here. Don't report any payments that the insurer has made directly. And this is to be used when the employee is not working. Again, back to the kind of principles for reporting leave when there's no work being performed or they're absent from work. On to the next slide. So
workers' comp, just to sort of have another sort of segue there, common one is light duties and top-up payments. If the employee's working, it's not leave. And equally, that's another one for super. So workers' comp, not worked is not subject to super, but if an employee is working, you absolutely need to be paying them super under the super legislation. And workers' comp and some of those other types of superannuation exempt leave are also a bit of a sleeper from time to time, where the overlay of awards actually says that those elements are entitled to the instruments say that super is payable on all paid leave, which brings certain leave payments that would otherwise be non-superable into the superannuation net.
A question for you guys, because I know that some states allow people on workers' comp to sort of take annual leave. Would that then mess with the buckets that, well, whether it's a lump sum A, lump sum B payment? Is that something that we need to consider?
You want to take that one, Austin?
Yeah, potentially, depending on the type of leave that they're taking. If it's distinct from that period where they are workers' comp, then you need to be reporting it under that particular leave category.
Thank you.
Yeah. So paid leave type O is your other category. And like we said, it's essentially the catch-all for any type of leave that you provide employees that doesn't fit squarely into any of the former 5 categories. And so your most common leave categories here will be sick or personal leave, annual leave, ordinary time, RDO and toil, study leave, etc. Important to note, and we cover salary sacrifice a little later in the session, but if employees are salary sacrificed to purchase additional annual leave, you'll effectively need to report that twice. So you have to report it as the salary sacrifice deduction. And then when the employee actually takes that purchased annual leave, you'll need to report it as type O. So that's one thing to keep in mind, and something that's probably a bit different from STP1. And then in the box in bold, we've got unpaid leave is not reported in STP2. And again, that goes back to kind of the principles driving leave reporting and the fact that there's no payment actually made for that time or that absence from work. So moving on. So next category is allowances. So there are 8 different allowance categories that are required to be split out. Oh, sorry, 9. So 8 on this page plus an other category. We'll be going through a lot of them in a bit more detail, but a couple that we'll just touch on just on this page. So the first one being AD, award transport. So this is payments you make to an individual that's directed under an industrial instrument, and it's used to cover travel or transport expenses. It's not used to cover any kind of meals, incidentals, or accommodation. The other one is the overtime meal allowance. So 37.65 is the rate for FY25. And the nuance there is that you're only required to report if you pay above that overtime meal allowance. Anything you pay that's under is not reportable. So we'll just flick to the next page. I think the first one is cents per kilometre. So when we talk about cents per kilometre allowances and the reporting of, it's essentially a two-limbed test. The first is whether the allowance is seeking to cover private or business travel. If it's private travel, then it's reported as an other allowance and you flag it as non-deductible. You're only really reporting those that are business-related travel in this particular category. The second hurdle that you need to look at is whether you're paying the cents per kilometre allowance in respect of a car. And so various legislation defines what a car is, a passenger vehicle that's designed to carry fewer than 9 passengers. And so if you're paying an allowance that's for business travel and to compensate the use of that car, then that's where you report it in allowance CD. The next one I think is laundry allowances. So again, another kind of two-pronged question before you get to the answer of whether you report under LD or not. First one is the same as the cents per kilometre. So is it deductible? Are you providing your allowance for a business purpose, or are you covering private expenses? And again, if it's non-deductible or an allowance, then it non-deductible or private, then it's reported as OD and flagged as non-deductible. Once you pass that first hurdle, the second is what kind of costs are you actually trying to cover with this allowance? And the rule is it needs to be an approved uniform or protective clothing. So approved uniforms are registered in the approved clothing register. And then protective uniforms are things, like fire-resistant clothing, coloured vests, etc. So if you meet those two hurdles, then you report it under LD. If you fail at any of those first gates, then you report it as other. Just on the next slide. So travel allowances. So we've got a nice flow chart there that sets out essentially the 3 questions you need to consider before you get into reporting under RD. So again, the first is the nature of the travel. Is it private or business? The second is whether it's overnight or day travel. And so that goes to the point we had earlier around travel that takes place during ordinary hours. The travel reported at RD really only covers any overnight travel. And then the third test is whether travel is domestic or overseas. So overseas travel gets reported at OD with a description of general. And then if it's travel, then you're into this RD category. The last step in the kind of decision tree is whether or not the amounts you're paying are above the ATO reasonable amount. So to do that, a lot of payroll systems will have the tables built in at the start of each year. But the current tax determination is TD 2024/3. And that's got each of the tables that sets out the salary bands and the locations to then determine what the reasonable rate is. And you only report through STP if you pay above the reasonable amount. Anything below is not reportable. And then I think the last two before we get into other, so we've got qualification and task allowances. So qualification is used when you're covering expenses related to qualification or certifications of employees. So there's a number of different examples there. And then task allowances are used to cover allowances where you're supposed to be working in certain conditions or work type. So you've got danger allowance, freeze allowance, high duties. And a lot of these may be determined by the award as well. And so that overlay of whether employers are entitled to certain allowances under award needs to be considered when kind of paying those types of task allowances. Then the last category we've got is obviously other. So similar to gross and similar to leave, any other allowances that don't fit squarely into those 8 buckets that we've talked about will fall into here. And there's a few examples that we talked about previously. So for transport, for example, if you're reimbursing private travel or you've got overseas related travel allowances, and that goes into this other bucket. If you've got non-deductible expenditure that you're reimbursing, paying allowance for, then that will go into this other bucket. And then the other one that's noteworthy is the private vehicle. So where you're paying allowances for non-cars, and we talked about what the definition of a car is, or you pay a flat rate car allowance, so something that's not stipulated by a cents per kilometre calculation, then that goes in the OD bucket. Anything to add on those ones, Nathan? I think.
No, I think that's fine. I think it's so much content. I'll let everyone digest and maybe not burden them with even more for the minute.
I'm learning,
Yes.
that's for sure.
And so the next 2 slides are just some common mistakes we see employers get tripped up on in relation to allowances. So specifically for the OD category or other allowances, we often see commissions or end-of-year bonuses paid under the allowance category, but we know that there's a specific bonus category that STP2 requires us to report under, and so those would go into there. Penalty rates, we talked at the outset about the distinction between penalty rates and overtime. We also see some employers put in penalty rate payments as an allowance rather than reporting it as gross. And then laptop mobile phones. So again, there are specific categories depending on their use, and some of which need to get onto a tool allowance or a specific category of the OD allowance. It's the home office. And then meal allowances, which we covered briefly in the overview of the allowance section. There's a specific category where you pay overtime meal allowances, and that's category MD. If it's a shift meal allowance, so it's not overtime, it's just a payment you make in relation to ordinary time, then that will fall into category OD. So again, I think the comment there is just understanding the nature of the payments and whether they do fit into any of the categories before you get into the catch-all buckets.
You really need to understand what you're paying and why.
Yeah. 100%. It's not a set and forget, right? And if it's easy to get lost in the system, and I mean, in payroll, that is it, right? But finding a way to step out of that and actually understand who are the workers in this business, what do they do? HR obviously should play a big role in that, but why do we pay them we pay them? Is it under their contract? Is it because they're under a particular award, or is there an enterprise agreement? And there's that. It then informs, well, what is the actual character of all these elements that we're giving them, and it makes your configure. It's impossible to configure things appropriately if you don't have that context.
Yeah. So
Absolutely.
Thank you. It's a lot. It's a lot to take in.
It's a lot.
So some of these we actually have covered during the allowance section, but I think the first one's quite important. As you may have seen as we've gone through, there is an inconsistency in the way or in the amounts that need to be reported. So as an example, some allowances require you to report on everything that you pay where it's business related. There's others, like travel allowances, you're only required to report the excess above a certain ATO threshold. And so, often clients might think, well, one way of reporting allowance applies to all, and so they fall foul of those particular nuanced rules. Incorrect use of overtime meal allowance, I think we talked about, and so making sure that it does relate to meals provided during overtime periods. Reporting incorrect amounts, so there's no need to report reimbursements, and fringe benefits don't need to be reported, even laughers as an allowance. Last,
Living away from home allowance.
living away from home, yeah. Sorry.
Thanks, Rachel. As long as it is a living away from home allowance, as per the FBT definition, so it's the one cash item that goes through payroll that actually falls in FBT potentially, and if it doesn't, it would need to be taxed.
And then the last is the disaggregation of all-purpose allowances. So splitting up any all-purpose allowances, and again, you might need to refer to the instrument to work out what's actually been provided in that catch-all allowance. So the last kind of 2 points in the disaggregation section, salary sacrifice. So this is changed from SDP1. Obviously, there's a new category of salary sacrifice super, which needs to be reported. And then type O is any other salary sacrifice. So novated leases, purchase leave, etc. will be under type O, sorry. And again, similar to what we talked about in the leave component, you report the deduction, and then once the leave's taken, you report it as leave type 0. The next is just to cover off on reportable employer super contributions and salary sacrifice super. Somewhat annoyingly, I guess the system does require you to report both, and they've got different purposes. RESC is used to help determine study loan payments in Centrelink, and so is really a key attribute that's required by Services Australia, whereas salary sacrifice super is more in the domain of the ATO to reconcile what you've paid from a cash perspective versus what the take-home pay is of that particular employee. I mean, the two do overlap. In some instances, your RESC might be a salary sacrifice amount, but I think the key difference is that the RESC bucket is a bit broader than just salary sacrifice. So it includes any type of super payment that the employee's got capacity to influence or control. And so that can be a pre-tax salary sacrifice. It can be an agreement in a contract that stipulates a rate that's higher than the statutory rate. Or it could be the provision of a bonus where you voluntarily contribute a portion of it to super. So if you've got any instance where that arises, then you'll need to report it as a RESC payment. And so just remembering the kind of distinction between the two is important. I think the last slide, just to wrap up on this particular section, is just some of the common reporting issues. So first one, I think this might have changed from what I've got, but so treatment of back pay, it's just lump sum E. So anything that relates to the prior year, you report as lump sum E. Anything that's happened in the current year, you report in the normal categories you would as your other payment amounts. Termination payments. So ETP is a standalone category. So, severance, redundancy, gratuity type payments. There are specific categories that you need to report on in the ETP section. So that's total taxable component, any tax-free component, total tax withheld, and then your ETP category. And then the other three there, so, incorrectly selecting a non-reportable flag when it is something that needs to be reported, using the incorrect country code, and then reporting on deductions. Like we said, deductions aren't required to be reported unless they're salary sacrifice. And there's a separate kind of reporting for child support deductions.
Yeah, post-tax, pre-tax salary sacrifice. I think you're referring to there, Austin.
Yep. So yeah, key takeaways. Obviously, configuration is important to ensure that the setup's correct. You're not just relying on kind of what's been in the system historically. Understanding the nature of the type of payments that you're paying and how they link in with the particular codes, and being aware of the distinctions within each of the categories. Allowances require you with certain reporting versus, ones that are just the excess, and then the distinction between penalties and overtime is an important one.
Good stuff. We might just rocket through, Rach. There might be one slide which we'll fast forward through. You can have a look at that at your leisure. Your STP reporting does need to be finalised by 14 July. But we are sort of getting close to time, and I'm pleased to confirm that the last parts about payday super and payroll tax are much shorter and sharper. So you're on the downhill run. Go forward, Rachel. So I talked about payday super right from the outset. So it is due to come in from 1 July next year. And as I mentioned, it will require some preparation and forward thinking, including for businesses like ELMO, Rach, as I'm sure you're already very well aware. As you know, businesses prepare and further guidance and legislation gets released into how that scheme's going to operate. But with respect to the STP reporting specifically, the guidance has indicated that there will be changes to STP required to specifically report ordinary time earnings and employer superannuation, which will give that direct one-to-one reconciliation for the ATO to be able to identify, well, you know, what is ordinary time earnings, what's the super paid, and it's then going to be very, very clear for the ATO to determine whether superannuation has been paid at the applicable statutory rates, and obviously the timing of that super will be evident as well. Just forwarding to the next slide, Rachel. So I mentioned it is 1 July next year. The purpose of it, I think, is pretty self-evident. So looking to minimise unpaid and underpaid super, greater transparency, and more money in your super funds for retirement, which is good for everybody. The ATO does perceive a really significant superannuation gap. I think the most recent ATO statistics estimated something like $5.1 billion a year of superannuation being underpaid. And of that, I think it's only about $1.5 billion or something like that the ATO has been recovering through compliance activity. So there's a real perception that there's just, you know, not enough superannuation compliance. Better data and more timely data gives the ATO better tools to deal with that. And faster payments is better for employees. Right now, there's some clients that already do pay effectively on payday. Some pay, you know, with monthly, and there's plenty that still pay quarterly on the 28th after the end of the quarter. That's going to be a thing of the past. It's going to be a 7-day requirement between payday for those from payday to get those funds into the employee's superannuation fund, with limited exceptions. The new base for super is not changing in terms of the fundamental principles, but we're going to use the term qualifying earnings as opposed to ordinary time earnings. And I believe that's driven by just the need to have a bit of a distinction between the use of a term like ordinary time earnings that might have relevance in, or it does have relevance in other contexts that is not necessarily superannuation driven. There will be there's proposed to be an annual superannuation cap instead of a quarterly cap, which will bring in some other interesting challenges as we sort of work out what that looks like and how your system needs to be configured to correctly cap super now on an annual basis as opposed to quarterly. I'll get to the consequences of underpaying superannuation in a second. But one feature of the current superannuation guarantee system is that if you incur the super guarantee charge, that's non-deductible for income tax purposes. It's part of the penalties, if you like, that come from super non-compliance. In payday super, your charges under that regime will be deductible. Next slide, please, Rachel. So what is this superannuation guarantee charge? So what happens if you don't get the funds into an employee's account by the applicable date, or you underpay? Under the current regime, the superannuation guarantee charge is combined of three components. It's made up of effectively the amount of super that you underpay, which gives rise to a shortfall percentage, effectively the percentage by which you've underpaid. And then you multiply that by salary and wages as opposed to ordinary time earnings. So there's your first sort of stick. You're going to end up paying a little bit more under SGC than you will if you're paying super on a timely basis, because super is being applicable in respect of a broader base. You've then got 10% simple interest, a $20 per quarter administration fee, and potentially a Part 7 penalty, not a Part 7% penalty, but a Part 7 penalty of up to 200%. Under the new regime, it's a little bit simpler, but quite different as well. So, as I said, it's deductible, but your superannuation guarantee charge will effectively be the amount of super that's been underpaid. There's no more salary and wages uplift anymore. There is still interest, but it's now a daily compounding interest based on the GIC rate, so the general interest charge rate. And then the penalty component has been replaced by what's called an administrative uplift amount, which starts at 60% and is remitted down from there. So moving on to the next slide, Rachel, I'll just talk to what this 60% charge means and how that features into compliance. So 60%, it's a little bit different to the current Part 7 penalty. So the Part 7 penalty is theoretically starts at 200%, but gets remitted down. But typically, as long as you're voluntarily dealing with things under the current regime, you generally get you can generally get a nil penalty outcome. Under payday super, you automatically get a 60% uplift, 60% penalty, and then that's reduced based on two elements. One, whether the commissioner has previously made a unilateral SGC assessment, so like an ATO initiated audit style assessment, and whether you've lodged a voluntary disclosure statement and when you're lodging that. So you start with 60%. You'll get 20% of that knocked off under that first limb. So if the commissioner has not initiated assessments, and you've got a good compliance history, straight off the bat, you can expect your 60% to go down to 40%. So that's carrot one. Try to maintain good compliance history. Stay away from having the commissioner assess you for super non-compliance, because once you've been assessed, you're going to be copping 20% extra in terms of penalties. Now, assuming you've got that far, you're down to 40%. The remaining 40% will be remitted, provided it's disclosed within 30 days. And finally, if it's beyond 30 days, it's 15% remission on a sliding scale between 30 and 120 days. So what's the upshot of that? So basically, right now, if you find a superannuation shortfall, you can do a historical remediation going back 5 years, and you might be able to get full remission of penalties if you're making a voluntary disclosure. Under payday super, if you're not making a disclosure within 120 days of payday, the best case outcome will be 25% or 40% if you've previously been assessed under one of those commissioner-initiated assessments, which leads to the importance of structuring things to ensure that you stay in front of compliance, get it right, or at best, at least ensuring you're capturing it quick enough so you're fixing things within 30 days. Next slide, please, Rachel. So what does that look like as you look ahead and start to prepare? We've put it in 3 buckets. First of all, you want to really understand what are your internal processes and timelines that impact how quickly you could pay super today. So, what does your employee onboarding look like? Are you getting the information from your employees quick enough to ensure that you have their super fund details and know where to send their super? How quickly does your payroll get signed off, and how quickly do the payroll payments get approved? If that currently takes a few days, well, you're losing time, straight off the bat. What are your service levels in your agreements with your clearinghouse and payroll providers? Does your clearinghouse need a certain number of days in order to get the funds where they need to go? Those days will eat into the 7 days that you've got to get the funds where they need to go. And things like processes for dealing with bounce back. All of these points in the chain that have the potential to delay, you want to be clear and tighten those as best that you can, because in the new world, you just don't have much margin for error. Second bucket, and we've talked about this to death, so I won't talk about it in more detail, but review your payroll configuration. Make sure all of your pay elements are configured appropriately for super, and then it's doing the right things from a capping perspective and the like as well. And then finally, and this is really important as well, particularly given that tight window to disclose errors without penalties, is make sure you implement appropriate checks and balances. So some of our clients actually already do have processes outside their payroll where they do effectively parallel superannuation calculations and ensure that super paid per employee matches super calculated. Models like that are going to be really, really important in payday super world, because you just need to have mechanisms in place to catch super underpayments because of those punitive penalties that are attached. I might actually finish there, Rachel. Just in the interest of time, even though it's a webinar, I don't know if you can just make them longer, but I feel like that's been long enough and is more than enough content. We'll leave the payroll tax slides in there, and we can obviously take questions.
Yeah.
It just includes some of the common risk areas that we see under audit and common risk areas that common errors that our clients make. But you can have a look at that and reach out to Alston or I if you've got any questions.
Excellent. Thank you both. So really the summary of this is knowledge is power. You need to know what you're doing, what your employees are doing, and what you're paying and why.
Absolutely.
And beyond to your employee onboarding in those super choice forms.
Correct.
Thank you both for your time. I really appreciate it. And I know that Elmo clients will really, really appreciate it as well. And if you guys do have any questions out there, please feel free to reach out to Elmo, reach out to A&M, and hopefully everything will be all right at tax time and with Payday Super. Thank you both so much.
Thanks for having us.
Appreciate it. Bye, everybody.
Bye.